I know that a lot of people are nervous in this market, so I thought I'd relate a story of my son Maximus and I were talking the other day. He asked, Dad, why and how does Procter & Gamble continue to pay their dividend even though the share price is down? And I said, all right, think of it this way, Maximus. If Procter & Gamble is selling at $100 a share and they're paying $3 a share in dividends, that would be a 3% dividend yield. Now let's say that Procter & Gamble is selling less razors. So I'm shaving with my Gillette razor this morning, and I was thinking, let's say they have a bad year and they're not selling as many razors because some of us don't have jobs, or maybe I'm growing more facial hair and that becomes a popular trend. And Procter & Gamble is selling less razors. And let's say their earnings fall from $6 down to $5 a share. They still have room to pay that $3 a share dividend. In fact, Procter & Gamble is a company that's paid increasing dividends for 20, 25 plus years. So what happens is Procter & Gamble stock comes down from $100 down to $80, let's say in a horrific scenario or a very volatile stock market that we're in, or a 20% decline. They're still able to pay out that 3% or $3 dividend. And actually the yield will go up to 3.75% because of the decline in the stock price. Take the dividend, $3, and divide it by the stock price of $80. That's why dividend stocks are so powerful too, is because what happens is as the stock price in the market declines, people start to invest first with more stable companies that pay higher dividend yields. That's why I've talked a lot about over the past year of not investing in these high-flying FANG-type stocks, Facebook, Amazon, Netflix, and Google, which we avoid that have ridiculously overpriced multiples and also don't pay dividends. Instead, our strategy is to invest like the Aardvark, the name of my new book that's coming out soon, wherein we collect the dividends, collect those easy ants, instead of being big game hunters, and simply not worry about the day-to-day market volatility of a particular stock. You have to think about it as if you're investing in a company. I'm sitting here drinking my Starbucks coffee that I picked up, and Starbucks is still making coffee, and we're still out drinking coffee. And it's okay if Starbucks goes down 2, 3, 4, 5, 10%. As long as they continue to pay their dividend, we're long-term holders and owners in Starbucks shares. Don't worry about the day-to-day volatility. It's easy to get caught up in the madness behind us here. You can see on CNBC or where everybody gets worried. But don't worry about that. If you're younger like me and you're almost 50, then you're taking those dividends and reinvesting them in share prices that are lower. And if you're retired and need income, then you're simply taking that income and using it to supplement your retirement income. So I hope this tip helps. I hope it helps alleviate some of your fears in this volatile market. And I wish all of you a very happy Thanksgiving. Bye-bye.